School of Management Studies IGNOU presents an audiobook on the course MMPC 003 Business Environment for MBA program. Presenting Block 3 Structural Reforms, Unit-8 New Economic Policy Part 1. After completing this unit, you should be able to understand the history of economic reforms introduced in 1991, discuss the meaning and measures related to liberalization, privatization and globalization, and discuss the latest economic policies of the government like Pradhan Mantri Jan Dhan Yojana, Mudra Scheme, Swachh Bharat Mission, Atmanirbhar Bharat and others. Introduction. The year 1991 is one of the landmark years in India's economic history, as economic reforms or new economic policy, that is NEP, or policy of liberalization, privatization and globalization, that is LPG, were initiated in this year. Indian economy witnessed a paradigm shift from the policy of license Raj to liberalization and nationalization to privatization. The introduction of economic reforms was not merely a coincidence, but the consequence of a multitude of problems that were brewing in the system for many years. Factors that led to the introduction of these policy changes can be classified into two categories, namely international and domestic. International factors like the disintegration of the Union of Soviet Socialist Republics, that is USSR, and the Gulf Wars. These factors led to a decline in Indian exports on one hand and a rise in crude oil prices along with a fall in international remittances on the other. This was translated into the balance of payments crisis, fall in foreign exchange earnings, and widening of the trade deficit. Domestic factors like burgeoning fiscal deficit and inflation further fueled the problem. The fiscal deficit reached a height of 8.4% in 1990-91 and the inflation rate was in double digits. India's foreign exchange reserves were fast depleting and they were sufficient for only 3 weeks of imports. India was in a precarious situation of default and debt. To overcome these crises, India approached International Monetary Fund, that is IMF, for grants and assistance. IMF provided assistance with certain terms and conditions which necessitated certain changes in the economic system. Further, the policymakers also thought that it was the right time to learn from the growth experiences of other countries like East Asian economies and to bring about a reorientation in the working of the economic system. This led to the introduction of economic reforms in India. These reforms have two main aspects, namely macroeconomic stabilization measures and structural adjustment measures. Macroeconomic stabilization measures included tax reforms, the balance of payment reforms, monetary policy reforms and inflation control. Structural adjustment reforms included new industrial policy, banking sector reforms, phasing out subsidies, disinvestment and others. Both these policy changes led to liberalization processes in the form of delicensing, dereservation and deregulation. Increasing the role of private sectors in the functioning of the economy and disinvestment connotes privatization. Further changes in trade policies like reducing the rates of duties and tariffs made trade attractive, the flow of FDI and integration with world economy or globalization. Our orientation shifted from inward-looking policy to outward-looking policy. The combination of liberalization, privatization and globalization ushered a new era in the economic history of India. GDP numbers increased, industrial activities gained momentum, services sector bloomed and the presence of India on the global platform was being recognized. However, the story of economic reforms is not without criticism, like jobless growth, neglect of the agriculture sector and unskilled labor, the rise in income and wealth inequalities, and many others. New Economic Policy 1991. Liberalization, privatization and globalization, that is LPG, form the main component of New Economic Policy 1991. In the following section, you will understand about the meaning of liberalization, privatization and globalization and the various measures undertaken to achieve the objectives of these policy measures. Liberalization. Liberalization refers to curtailing or lessening of the excessive state or government regulations and restrictions as to enhance the participation of private entities or sectors in the functioning of the economy. Prior to the policy of LPG, the Indian economy was entangled in bureaucracy, excessive state control, red tapeism, and license raj. These factors not only inhibited the efficiency of the public sector, but the overall competitiveness of the economy was hampered. Post-1991, liberalization measures include new industrial policy, financial sector reforms, tax reforms, forex reforms, and others. In the industrial policy of 1991, several measures were undertaken to liberalize the economy. First, the list of projects requiring industrial licensing was pruned and only 18 industries related to security concerns, environment, hazardous chemicals, white or luxury goods, etc. were kept under the purview of compulsory licensing. Second, industries reserved for the public sector were reduced to only 2 industries, that is, one related to atomic energy and second, railways. Third, the requirement of licensing for setting up of industries within 25 kilometers of the periphery of cities having a population of more than 10 lakh for a certain class of industries was removed. Fourth, to boost and invite foreign direct investment in high priority industries, which requires heavy lump sum investment and advanced technology, it was decided to provide approval for FDI up to 51% of foreign equity in 33 industries, like electrical equipment, metallurgical industries, etc. Similarly, to inject technological dynamism in Indian industries, the government provided automatic approval for technology agreements related to high priority industries with specific parameters. Fifth, the Monopolies and Restrictive Trade Practices Act, that is MRTP 1969, was repealed. And sixth, the Sikh industries were referred to Board for Industrial and Financial Reconstruction, that is BIFR, for the formulation of revival or rehabilitation schemes. Privatization. Privatization in a broader sense means a change of ownership from the public sector to the private sector and the induction of private management and control in the public sector. 3 broad measures of privatization are ownership, organization, and operational. Under ownership measures, the ownership of public enterprises, fully or partially, is transferred to the private sector. Ownership measures include total denationalization, joint venture, liquidation, and workers' cooperative. Total denationalization means 100% transfer of ownership of public enterprise to the private sector. A joint venture implies partial transfer, that is 25%, 51% and 74% of public enterprise to a private entity. Liquidation is the sale of assets to a person who may use them for the same purpose or some other purpose. Workers' cooperative is a special form of decentralization whereby the ownership of the enterprise is transferred to workers who may form a cooperative to run the enterprise. Organizational measures are imposed to limit state control. These measures include the formation of a holding company structure in which the government provided a sufficient degree of autonomy in the decision-making of the company. Big companies are split into smaller units without loss of economies of scale. The smaller units become independent in certain product lines or regional operations. Leasing is another measure whereby government agrees to transfer the use of assets of a public enterprise to a private bidder for a specified period, for example 5 years. The tenderers have to give an undertaking of the profit that would be passed over to the government. The government enjoys the right of obtaining profits as per agreement. In case the bidder fails to meet the expectations of the government, the latter has the right to replace the bidder with a more promising bidder. Further, restructuring intends to bring public sector enterprise under market discipline. Restructuring is of two types, namely financial and basic. In financial restructuring, accumulated losses are written off and capital composition is rationalized in respect of debt-equity ratio. In basic restructuring, the public sector sheds some of its activities which are taken up by ancillaries or small-scale units. Operational measures aim to improve the overall functioning of the economy, even if fully denationalization has not been undertaken. Operational measures include granting autonomy to public enterprises, provision of incentives to the employees, freedom to buy inputs from the market, development of proper investment criteria, permission to raise resources from capital markets for expansion or diversification. Various measures in the industrial policy like de-reservation of industries under the public sector, increasing the limit of the FDI in industries, disinvestment policy, the opening of private sector banks, restructuring of nationalized banks are some of the steps undertaken towards privatization. In the 1991 budget, the government announced the intention of partial disinvestment in selected PSUs in order to raise resources, encourage wider public participation, and promote greater accountability. Up to 20 of the government equity in 31 selected enterprises were offered to mutual funds, financial investment institutions, workers, and the general public. From 1991 to 1999, through the disinvestment method of market sale of shares of rupees 18,638 crore were realized. Globalization. It refers to the integration of the domestic economy with the rest of the world. Globalization connotes the reduction of the trade barriers to permit free trade, free flow of capital, technology, and labor. The important measures undertaken to pursue the objectives of globalization are: Number 1. Reduction of import duties. Reduction in import duties have been important measures for improvement of the tax system. During 1990, import duties were 300% or more for several items and above 200 for many items. Peak rates were trimmed progressively during the 1990s to reach 35% in 2001-2. The median tariff rate was brought down to 25% in 2003-4. Besides reducing import duties, the government attempted to dismantle the quantitative restrictions on imports and exports. In the import-export policy of 1990, the list of open general license, that is OGL, was expanded to facilitate easy access to the import of items. The number of capital goods was expanded from 1,261 to 1,343 under OGL. A scheme of star trading houses was introduced for exporters with an average annual net foreign exchange earning of Rs 75 crores in the preceding 3 licensing years. Number 2. Encouragement of foreign investment. As we have seen in the industrial policy of 1991, automatic approval would be given for FDI up to 51% in high priority industries. Further, in 1996, a new list of industries was approved whereby joint ventures with up to 74% foreign equity would be cleared automatically. In 2021, 100% FDI through automatic route is permitted in major subsectors of mining, broadcasting, airports, industrial parks, telecom services, pharmaceuticals, single brand retail trading, textiles and garments, thermal power, tourism and hospitality, white label ATM operations, and insurance intermediaries, etc. Now, having a glimpse about the new economic policy of 1991, we understand that nearly 3 decades have passed since the introduction of economic reforms, and over time the results of these reforms have faded. So the need is felt for looking at recent policies and changes introduced in the economy and try to see how these policies and programs are shaping the economic landscape of the country. In the upcoming section, we shall study the major changes and new policies which have been introduced over the past decades. New Economic Policy 2014. Foreign Trade Policy FTP 2015 to 2020. One of the important policies which affects the external sector is the foreign trade policy in India, and each FTP or foreign trade policy brings new changes in the economic policy of the country. FTP is formulated every 5 years, and currently foreign trade policy for the year 2015 to 2020 is in force. The major features and highlights of the FTP 2015 to 2020 are: Number 1. Export from India scheme. Under this comes Merchandise Export from India scheme, that is MEIS. Under this scheme, the scrips which will be issued will have no conditionality attached to them. The notified goods which are exported to notified markets would be rewarded on realized free on board, that is FOB value of exports. Under this scheme, countries of exports have been grouped into 3 categories, namely Country A, B and C. Country A or traditional market includes USA, Canada, EU and others. Country B or emerging and focus markets include Africa, Latin America and Mexico, Turkey and West Asian countries, ASEAN countries, Japan, China and others. Country C contains the list of 7 countries like Bangladesh, Bhutan, Nepal, etc. Further, different types of supports like global support are extended under MEIS. Global support has been granted to fruits, flowers, vegetables, tea, coffee, spices, processed foods, marine products, handicrafts, furniture, etc. New 852 tariff lines that fit in the product criteria but were not receiving support in earlier foreign trade policy have been extended this support, and these include lines from fruits, vegetables, Ayush and herbal products, paper products, etc. Next is Service Exports from India scheme, that is SEIS. Service exports from the India scheme have replaced the old Served from India scheme, that is SFIS. This scheme aims at promoting exports of services from India to make services more competitive in the global market and to provide incentives to exports. Under this scheme, incentives ranging from 3% to 5% are provided to the exporters of services who are providing services from India to the various organizations situated outside India. The rate of incentive under SEIS is computed on the net foreign exchange earned. Business services, communication services, construction and related engineering services, educational services, environmental, health-related services, recreational services are covered under a 5% rate. Services like hotels, restaurants and other services attract 3% rate. The rewards earned in this scheme in the form of duty credit scrips are freely transferable and can be used for all types of goods and service tax debits on procurement of services or goods. The benefits of MEIS and SEIS are also extended to special economic zones. All duty scrips issued under MEIS and SEIS scheme and the goods imported against these scrips are fully transferable, and scrips issued under exports from India can be used for payment of customs duty, excise duty, and payment of service tax. A new concept of status holders has been introduced in Foreign Trade Policy 2015 to 2020. Business leaders who are prominent in the arena of foreign trade and have successfully contributed to the country's foreign trade would be termed or recognized as status holders. These holders would be given special treatment and privileges to facilitate their trade transactions. Boost to Make in India. In view of encouraging domestic manufacturing and promoting Brand India, several measures have been introduced under FTP. Under MEIS schemes, higher rewards will be provided for those export items which has high domestic content and value addition. Under the Export Promotion Capital Goods, that is EPCG scheme, the specific export obligation has been reduced to 75% in case capital goods are procured from indigenous manufacturers. Ease of doing business. For trade facilitation and ease of doing business provision for online filing of documents or application has been made whereby various applications by exporters or importers can be filled online. Further, there is no need for hard copies of applications and specified documents. Landing documents of export consignment as proofs for the notified market can be digitally uploaded. Goods and Service Tax, that is GST. One of the major initiatives or reforms in the Indian tax sector was the introduction of GST. GST Act was passed in 2017 by the Parliament and came into effect from 1st July 2017. It is a comprehensive, multi-stage, destination-based tax that is levied on every value addition. Prior to the introduction of GST, there were a plethora of taxes levied by the central and state governments which lead to cascading effects of the taxes. GST has subsumed a large number of taxes and intended to simplify the structure of the indirect taxes. At present, there are 4 types of GST, namely Integrated Goods and Service Tax, that is IGST, State Goods and Service Tax, that is SGST, Central Goods and Service Tax, that is CGST, and Union Territory Goods and Service Tax, that is UTGST. The major benefits accruing from GST are the creation of a unified common national market for India, giving a boost to foreign investment, and the Make in India program. Other benefits include mitigation of cascading of taxes, harmonization of tax laws and procedures, simpler tax regime, increase in ease of doing business, reduction in compliance cost. For consumers, benefits are in the form of reduction of prices of goods and transparency in the fixation of final prices of the goods. More detailed information about GST is given in the Unit 9, which we will discuss shortly. Pradhan Mantri Jan Dhan Yojana. To widen the scope of financial inclusion in the country is the ultimate goal of inclusive growth. To bring the backward and marginalized citizens of the country under the umbrella of institutional sources of finance is the goal of the Financial Inclusion Program. The Government of India launched one of the biggest initiatives for financial inclusion on 15th August 2014, namely Pradhan Mantri Jan Dhan Yojana. The mission was launched with the objective of making financial products and services approachable to the common citizens of the country at the least cost possible, with the extensive use of technology to expand the coverage of financial inclusion. The basic tenets of the scheme are to provide basic banking services to unbanked citizens in the form of opening a basic bank saving account in any bank branch or business correspondent with zero balance and zero charges. This scheme also provides debit cards with free accident insurance coverage of Rs 2 lakh. The 6 main pillars of the scheme are universal access to banking services, overdraft facility of Rs 10,000 with every basic saving bank account, expediting the program of financial literacy in the form of spreading information about the usage of ATMs, promotions of savings, use of banking services for insurance and pension, creation of credit guarantee fund to save the banks from defaults, to provide insurance cover with both accident insurance up to Rs 1 lakh, which is enhanced to Rs 2 lakh to new Prime Minister Jan Dhan Yojana accounts opened after 28th of August 2018, and life insurance of Rs 30,000, as well as to provide a safety net to the workers working in the unorganized sector through a pension scheme. Pradhan Mantri Jan Dhan Yojana account can be used for direct benefit transfers, that is DBT, for the social security schemes, namely Pradhan Mantri Mudra Yojana, that is PMMY, Atal Pension Yojana, that is APY, Pradhan Mantri Jeevan Jyoti Bima Yojana, that is PMJJBY, and Pradhan Mantri Suraksha Bima Yojana, that is PMSBY. Post 2018, the focus of Pradhan Mantri Jan Dhan Yojana has shifted from every household to every unbanked adult. The overdraft facility has been increased to Rs 10,000 from Rs 5,000, and the age limit for the overdraft facility has been increased to 65 years. As of April 2021, the total number of Pradhan Mantri Jan Dhan Yojana account stood at 42.25 crore, and in these accounts, Rs 1,45,408.07 crore was deposited and 30.93 crore rupee cards were issued. Further, Jan Dhan Darshak app was also launched to provide necessary information related to banking services like locating ATMs, bank branches, etc. Mudra scheme for MSME. To revitalize and meet the credit need of non-corporate, non-farm micro and small enterprises, Prime Minister Mudra Yojana, that is PMMY, was launched in 2015. These micro enterprises play an important role in labor surplus country like India. These enterprises are labor intensive, need less credit, caters to local economy needs, and play a supplementary role to the medium and large industries. However, they reel under the problem of deficiency of finance and depend upon non-institutional sources of finance like money lenders. So, to expand the ambit of the institutional sources of finance to this sector, PMMY was launched. Mudra stands for Micro Units Development and Refinance Agency and provided loans up to Rs 10 lakh to eligible enterprises. Mudra is a wholly owned subsidiary of Small Industries Development Bank of India, that is SIDBI, with an authorized capital of Rs 1,000 crores and 750 crores of paid-up capital. Micro enterprises can borrow term loans or overdraft facility without any need for collateral, processing fee, and this scheme does not prescribe any minimum amount of loan. Small to small loans can be taken. Mudra schemes have 3 categories, namely Shishu, Kishore and Tarun. Under the Shishu scheme, a maximum loan of Rs 50,000 is sanctioned for startup micro enterprises. Kishore categories cater to the need of entrepreneurs who are looking for a fresh fund for the expansion of business and they can avail the loan ranging between Rs 50,001 to Rs 5 lakh. If the entrepreneurs are looking for diversification of their operation, then they avail the loan facility in the Kishore category. Under this category, the loan amount sanctioned is Rs 5 lakh to Rs 10 lakh. Entrepreneurs can take a loan for the commercial vehicle, plant and machinery, business loans, and working capital. In the financial year 2020-21, Rs 43 crore 37 lakh and 3 PMMY loans were sanctioned. Swachh Bharat Mission, that is SBM. On 2nd October 2014, Prime Minister Shri Narendra Modi launched a multi-pronged program to augment the sanitation drive in the country, namely Swachh Bharat Mission, that is SBM or Clean India. This program was launched at the backdrop that in 2014, more than half of the population, that is 55 crore people, practiced open defecation. The situation was not only grim in a country like India alone, where nearly 2.3 billion people globally lacked basic sanitation services. The situation was not only grim in a country like India alone. Nearly 2.3 billion people globally lacked basic sanitation services. Under SBM, beneficiaries were provided with an incentive of Rs 12,000 for the construction of individual household latrines. The financial burden was shared in the 60:40 ratio between the central government and state government. However, in the case of special category states like J&K, Himachal Pradesh, northeastern states, this participatory role increased to 90:10. Further permission was also granted to create avenues for additional contributions from other sources also. SBM is not about providing just financial incentives, rather it is about capacity building and aims at instilling behavioral change among communities and individuals. Since its inception, the percentage of fund utilization under this scheme has been more than 95%. Nearly 10 crore toilets have been built since 2014 and 711 districts declared as free from open defecation. You were listening to the audiobook by the School of Management Studies IGNOU for MBA program. Course code MMPC 002 Human Resource Management. Course Coordinator Professor Nayantara Padhi from School of Management Studies IGNOU. Voiceover by Harpreet Kaur. Edited by Ruchi Sharma. Program assisted by Tarannum Jahan. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.